So, good morning. I'm here today. I'm joined very kindly by Alex Chartres of Ruffer. Alex is their Chief Investment Director and co-manager of two of their flagship funds. Sharon Bell, Senior European Equity Strategist at Goldman Sachs. And Seema Shah, Global Strategist at Principal Asset Management. Now today, I believe we've got a chart which sort of sums up what today's session is going to be mostly about. And so what this shows is the yield on the US 10-year Treasury going back over about 45 years. As you can see, it's been going down, and now it isn't. And that's basically what we're going to be talking about today. I know that's 40 years. That is probably most of the people in this room, if not all the people in this room, investment careers, investment kind of savings time. And so this is a massive change. And one of the big effects is something that people have already talked about this morning, which is the current banking crisis. And I think it's very hard to ignore that and launch straight into the inflation discussion. So Seema, how do you think the banking crisis is unfolding? Do you think that they've drawn a line under it with the Credit Suisse UBS rescue? Or do you think there's more to come?
Okay, so first of all, it's interesting that you said about the merger, because when we write notes, in one line it's a merger and in the next one it's an acquisition, and we're always fighting with that one. Okay, so look, I do think that this banking crisis is really pertinent to this issue. So I do think that policymakers have done almost enough to ring-fence these really unique issues. We've already talked about that this morning. But the reason that we're having this banking crisis is essentially, I think, down to the fact that central banks have had to raise rates in order to fight inflation. So now from here, I think there could be further stress. If there's further stress, I think policymakers are going to step in bigger size, do whatever regulators and central banks, authorities need to do. But it does have an implication for the inflation story, because, let's say that this month everything is fine. Let's say that the stress is gone. Central banks, the Fed can raise interest rates this evening, 25 basis points or so. And then everything's settled down. But imagine next month if you get a surprise upside print for CPI, right? The market is going to get really stressed out at that point. Policymakers are going to have to, I think, potentially step back. And at that point, they're almost admitting that fighting inflation is something that they cannot do. And it's, I think, an implicit acceptance of the fact that they cannot get inflation back to 2%. So I think it's really pertinent to this discussion.
Sharon, what about you? What do you think?
Yeah, just following on what Seema's just said, I do think central banks, we tend to think of central banks as fighting inflation, and that's their primary goal. But actually, their primary goal is always financial stability, superseding inflation. And of course, sometimes those things are fine. You can work on those together. And if you're not in a financially vulnerable time, you can fight inflation and raise rates, etc., as we have been seeing. But as soon as you see, and the UK last year during September was a really good example of this, during the pension LDI problems, where the Bank of England was literally just about to start doing quantitative tightening. They were going to start selling bonds. And they stepped back from that for a while in order to solve for their primary target, which is financial stability. And they said, actually, no, we'll provide liquidity. Actually, no, we'll start buying back bonds again. They were very careful to try and do so without creating moral hazard, but nonetheless, that is their primary target, to create this financial stability. So I do think central banks and regulators, even with this inflationary problem in the background, will still be, as their primary target, trying to make sure there's liquidity to the banking system, financial stability. And I do think the banking system has genuinely improved in the last 10, 15 years since the financial crisis. All the regulation has meant much lower levels of leverage, higher levels of capital, etc. Of course, in the end, the banking system is confidence. And if that starts to disappear, then you still have a problem. But, it's a dual mandate, really, for central banks. And I completely agree with Seema. If you're going to focus on the financial stability side, you're letting go the inflation side of it for a while.
Alex, I'd like to get your take on that point, but also to kind of maybe take that forward a bit. Isn't one issue, though, with a banking crisis that it is in itself massively deflationary? So if we get a sort of... We're kind of operating under the assumption that this isn't 2008 again. And I can see why, but what if it is more drastic than this and it spreads further?
Well, Why isn't it 2008 again? Probably because the capital regime for the big banks is much more secure. Why should you still be worried about the potential tightening effect of a credit crunch on the real economy? Because, well, if you're a loan officer somewhere, is this all making you more or less likely to lend credit to the real economy? Less likely. That's going to have pretty fundamental implications. For example, in the United States, I think we all know the stat, it's something like 70% of commercial real estate lending happens out of the regional banks. The regional banks, the epicenter of the problem. This is a classic example of Maginot Line-style generals fighting the last war. You know, they ring-fence the big banks, they try to protect them, and guess what? The problem's cropped up somewhere else. So whack-a-mole continues. So credit risk in the real economy, yes. Inflation risk is the flip side, because, of course, we know exactly from the violent agreement points we just heard that the revealed preference of central bankers is to dump money in the system when there's a financial stability issue. But remember, you mentioned the Bank of England. Most modern banks founded on the template of the Bank of England in 1694, not founded to control inflation, founded to get the government's debt away so we could rebuild Royal Navy after a drubbing by the French. Right? Central banks are wholly owned subsidiaries of governments, and that's the role they are going to revert to. So don't be fooled by the noise. Ultimately, this is a world we're going to have to monetize a lot of debt over time by stealth, preferably, so there isn't a kind of massive shock. But that is the direction of travel.
OK, so we all seem to agree that inflation, rather than a kind of deflationary bias, is going to be what we're getting for the foreseeable future. By the way, I know Francine showed you all how to use that Q&A thing this morning. So do send up your questions as we're talking. And if anything particularly exciting crops up, I'll pick it up and throw it to everyone. But yeah, so to carry on. So last year, the 60-40 portfolio, traditional asset allocation, equities, bonds, had its worst year in really, well, ever, pretty much. Is that a sign that something very fundamental has changed? And if it has, then what do we need to be considering as individual investors when it comes to our future asset allocation or how we think about it? Seema, you're in the hot seat again, I'm afraid.
I know.
Sorry.
I wish I'd repositioned myself back. OK, so last year was, as you said, it was a terrible year. Was it a unique year? I do think it was. Do I think it's going to go back to what it was before, where 60-40... I mean, in fairness, 60-40 hasn't really performed that well for a while. But will it go back to at least moderate performance? I think so. You know, we're probably going to go back to a time where inflation is a little bit higher than what we've had over the last decade. So in that situation, you know, maybe we don't have such a strong performance. I do think for 60-40, and this is, you know, you can see from the sessions later today, that people are thinking outside the box, right? It's not just about traditional equity, traditional fixed income. If you want to get any kind of yield, if you want to have any kind of returns for your portfolios, you almost have to step outside. And whether it's private credit, looking at alternatives, infrastructure, commodities, I think that has a bigger role to play. And real assets, it has to play a role in the next 10 years if you believe inflation is not dying.
Sharon?
Yeah, I mean, again, violent agreement, as you were just discussing. So I think that adding more real assets into your portfolio makes a lot of sense if you think that inflation is going to be more persistently high. And I think it probably will be, given the sort of resource constraints globally we have. And I do have sympathy with what Alex was saying. In the end, governments have large amounts of debt, and they will mind a little bit higher inflation this next cycle because it deflates that debt effectively. So I think given higher inflation, we're going to have a bit more of a mix in our portfolio. And I think 60-40, it's an interesting one. In this most recent sell-off, it would have buffered you a bit because the bond market rallied. So I don't think it's completely dead as a concept. I just think that perhaps adding some of these real assets in does make a little bit of sense as well. I also think it makes sort of a sense to consider, I mean, maybe for 10, 20 years, that chart you showed previously, that very first chart you had up, with bond yields collapsing over time. I'm an equity person, and I was often sort of asked, why bother with equities? You know, the bond market does so wow for so long. But of course, equities ought to provide you with some inflation protection. They are an ask on the real economy, effectively. And we have seen inflation this last year, and yet company margins held up quite well. I mean, inevitably, equities are cyclical, and they've been hit in this current crisis. But they also provide some inflation protection. So again, the argument for having those in the portfolio is quite strong too.
I mean, yeah, Alex, again, we mentioned real assets, I mean, what do we mean by real assets?
Real assets give you a claim on effectively inflation-protected flows and more expansively against debasement of fiat currency. So we've got some of those in the shape of inflation-linked bonds and gold and equities, as long as you pay the right price, are in that mix as well. But if we could just come back to last year and the 60-40, because it is a really critical point. We don't think inflation is just going to be high and stay high indefinitely. We think volatility is the watchword, precisely because we're going to get breakages like these in the financial system that will create deflationary lurches, that creates an inflationary policy response, and that's really difficult to navigate. So sometimes bonds are going to work, but last year the real lesson is that if you are solely reliant on conventional only assets to diversify your portfolio, there are going to be times when there are no hiding places. We've been worried about that for a long time, which is why we use derivatives, and that's how we delivered a positive return last year. But the historic context here is pretty simple. The entire financial industry pretty much operates on the assumption that bonds and equities are pretty consistently offsetting. That's only true for the last 20-odd years. And the reason it's happened the last 20-odd years is that inflation has been consistently on average below about 2.5%. And below that level, central banks do not have to worry about inflation getting out of control. So they can cut rates and print money, and that mechanically lifts bonds. But if there's even a little bit more inflation, we're not talking about Weimar wheelbarrow wage territory here, just over about 2.5%, maybe it's 3%, maybe 3% is the new 2%, then suddenly your bonds are less reliable. So the key is you need to be flexible, and we don't think you can afford to depend entirely on conventional assets.
I feel I need to ask this question, and also it's just popped up from one of the audience, so thank you for that. Crypto. Crypto was obviously an early casualty, rising interest rates, and FTX was the obvious blow-up there, and pretty much the whole sector's been shaken out. But one thing I have to say that we've written about a bit here at Bloomberg is that Bitcoin has done really well this year. And I know that a lot of people kind of thought or even hoped that it was going to die along with the rest of the sector. In the kind of rising interest rate environment, but it does seem to have some kind of staying power. So I'm just wondering if it's something that you ever consider for your portfolios.
Yeah, look, that's a really interesting question. So I remember last year going around the US, and I have to say I got a couple of questions a few times from people, well, not even questions, but comments, just saying that, look, you can't make money anywhere else, nothing is safe. So we're going to put our money in Bitcoin. So it was almost becoming this safe haven for some people, which was really bizarre. But I do wonder if, is that starting to return into some kind of psyche? I don't know. I will never understand that, I think. But I also say that last year, again, when we were interviewing people for asset allocation, so many people came in and said, when we said, present an idea, the one idea that everyone came in with was having Bitcoin in your asset allocation portfolio. 4% allocation, they said, was the perfect one, but every single candidate put Bitcoin in that asset allocation portfolio.
Why 4%?
Apparently, and I haven't done the maths, but apparently that is the ideal amount within a broad fixed income equities alts portfolio, is to then have a little bit of 4% in Bitcoin. Apparently, that is the ideal amount.
The magic number. Sharon?
I don't know. I think the problem with Bitcoin, so I understand a little bit why people have moved into crypto, because in some ways it's a competitor. It competes against the bank sector in a way, doesn't it? Against traditional money and capital. And if people are questioning, so whenever people question that, which clearly has happened in the last couple of weeks, people will move into something like crypto assets. I've also looked at this. If you popped it into your asset allocation with a very small percentage, maybe even less than 4%, would it really help? It does just up your volatility a lot, first of all. I mean, obviously, so it just creates risk. Maybe there's been good return over time, but how reliable is that? The other issue I have with crypto is that it doesn't correlate at all well with anything, and its correlations move a lot. So you can't sort of pin it down. In my sort of economics world, I like to say, okay, if I take a view on inflation or rates or GDP, then I have a good idea what will happen to bonds or equities or banks or a particular type of asset. With Bitcoin and crypto, I'd find that very, very tricky to work out. They don't have sort of very stable relationships.
John, don't go there. I know where you were going to go with that question, but headlines here, look, we had 5,000-year lows in rates we got a lot of very frothy stuff driven by magic money tree real-time experiment. Crypto was the long arm extension of that. It got whacked first as a result last year. Maybe there's a place for certain digital assets in a properly diversified portfolio. But I think I just want to dwell on what Sharon said there briefly about the nature of correlations, because we're all addicted in the finance industry as a whole to the data sets that are available to us. The data sets that are available to us are basically the last 30, 40 years. And that is defined by the chart you put up at the beginning. Falling rates, falling inflation, falling vol, great moderation. And that is not a reliable gauge to how the future happens. None of us know what data in the future looks like by definition. And correlations are going to change. That's what I was saying about the 60-40 portfolio. So you've got to be flexible. You can't rely on, oh, great, data set says 4% optimal, to exactly your point, Seema. 4% optimal, based on what? Based on Bitcoin's life for a little bit over a decade. I mean, so you've got to be flexible. You can't be wedded to old models, even if you think there's a little bit of change coming in. We think there's a lot.
And speaking of alternative assets, what about the physical Bitcoin or gold, as we prefer to call it? Do you think there's a place for that in a portfolio?
Well, I like to say gold is the new Bitcoin, John, so yes.
Sharon or Seema, do you have any views on gold? Or?
I don't know. It's that one question I really hate about gold, and it always comes up. Yeah, maybe yes, right? If you believe in inflation, the obvious place to go is gold. Is it interesting to me? No, not really. It's not the thing I go to. It's not a great answer, but the honest answer.
Just don't like it.
Yeah, I think higher inflation, gold is a kind of real asset in that context. And, I think having a little bit of a higher weight in a world of slightly higher inflation, 3% being the new 2% or whatever it is, then I think it makes a little bit of sense to have that bit in your portfolio. Yeah.
I think there's a bigger structural story which I'd also want to alight on, which is just we can feel the change in the air in terms of world order. Who was buying a lot of gold second half of next year after the Ukraine invasion? China and Turkey. Who's going to keep buying gold? Anyone who might find that their big reserves in dollars, euros, and European currencies are going to get weaponized. So I think there's a bigger structural buy going forward. I think in a multipolar, much more contested era, gold has a bigger role to play as a neutral reserve and FX asset.
Drawing like a geopolitical risk being higher, basically. Yeah.
I mean, in terms of geopolitical risk, this takes us to another question that's come up. And this seems like it is a very extreme scenario. But, okay, so this morning, for example, UK inflation, we expected it to go into single digits, and actually it's bounced, it's going up, and it's still in double digits. And there are a few countries around the world at the moment that are experiencing hyperinflation. Is anyone concerned that we might get either, maybe not hyper, but kind of like much more significant inflation? Because at the moment we're sort of sitting thinking, whenever I'm talking about, okay, we're moving into a more inflationary environment, I get the impression we're all really just talking about between, 3 and 7%, say, for the next X number of years, and 7's probably, a little bit, dramatic sounding. But is there a possibility that we get just wild levels of inflation? Is that something anyone's planning for or thinking about?
I think it's quite unlikely, very unlikely. I think the one scenario that you could see it happening, which again is very unlikely, is if, back to the kind of the labour supply issue, which is behind so much of the inflation, is in this new world, migration laws start to tighten further and further, and there's an outflow away from the west into the east, where there does seem to be greater growth prospects. Then maybe, but I think I doubt it. I think that the UK government, US government would hopefully reopen borders and try and find something to attract people back into the country.
And also, even though the labour market's very tight and wage growth has picked up and it's higher than perhaps the central bank would ideally like in the UK and other places, you've still got negative real wage growth, even with labour markets being quite tight. Labour wasn't able to extract out of its employer, whether that be the government or the private sector, enough wage inflation to actually compensate for inflation. So you don't have what you had in the 70s in a way, which was a bit this wage price inflation spiral. And there's a little bit of that going on, I'm not denying that, but I don't think it's as bad as that, because you're not getting the deals which are inflation and then a little bit more because I actually expect inflation to go up again. But I do think your question on the UK and the inflation print this morning is very, very valid. I was surprised by that. I think it shows you that perhaps, first of all, the UK economy is maybe not as weak as we thought. A couple of quarters ago, it would be unusual to meet someone who didn't think the UK was going to be in a recession right now. And actually, the data for the UK suggests it's not in recession. But if it's not in recession, that means demand's a bit better. And if demand is a little bit better, then that probably means inflation is going to be higher. Because labour supply is quite limited, because global resource supply is limited as well. So I think higher inflation, yes. The sort of really high hyperinflation, again, a bit like Seema, I think that's quite unlikely. I do think central banks, first of all, would step on that type of inflation. Yes, I agree. They may be happier to have 2 to 3 or maybe 4% inflation, but I don't think they'd be happy to have 10.
Yeah, we're not in the Weimar camp for the G7. But look, relevant context here. The first thing is we do think that the next decade, say, will be characterised by a higher level of inflation than we've been used to post credit crunch. What does that mean? Well, who knows? But it's not going to be a stable 2%, driven by net zero, which we just heard something about. Wars, hot and cold, we're in the middle of a new Cold War, are always and everywhere inflationary. You've got monetisation of the debt overhang. You've got all sorts of labour force issues and supply chain constraints we know about. But here's the really salient market point for us. This is a completely asymmetric proposition in terms of market pricing. Long-term inflation pricing, despite everything we've talked about, despite everything you hear in the headlines, flat as a pancake. And there's nothing in the market for higher levels of long-term expected inflation. You're being given a free hit. So if we do go back to the world we've been in, those long-term inflation expectations stay where they are, no change in price, happy days, other things in the portfolio work. But if it's right, there's going to be a big repricing, and you're going to get deeper negative real yields out across the curve. You're going to get higher long-term inflation expectations, which are currently flat as a pancake.
So in terms of, because I would like to just run through quickly the kind of equity area, because I know that's obviously where most private investors are often most interested. So Alex, you're just talking there about positioning yourself for an upward surprise in long-term inflation expectations, basically. On the equity side, what sort of things would you be buying with that in mind? What sectors or styles or countries, actually?
Price dependent. The only two things you can control are the price you buy it and the price you sell at. So if you pay the right price, logically, value is the place to be, because it's going to give you some kind of real return over a more inflationary decade. Lots of different flavours of value. You know, Japan, small cap, UK, mid and small cap, stuff full of them, those kind of places.
And any particular sectors that you're favouring?
Well, I mean, energy constraints, but obviously it's cyclical. But value is just a price question. It's not necessarily a sector. So you can find value tech, value hardware in the niches of the semiconductor supply chain coming out of Japan. There are lots of interesting opportunities there, and they don't trade rich.
Sharon?
Yeah, probably similar in a way. I mean, we've liked banks for the last sort of year, more or less, and for most of the time it's worked, but not particularly in the last couple of weeks. But I do think that value sectors, you can find lots of companies within sectors, and then broad sectors that look actually relatively inexpensive. So in Europe, there are 4 sectors. There's banks. But they're all bad sectors in a way from a sort of cyclical perspective. They're all cyclical sectors. They're all sectors with low returns, but they are sectors which are super cheap. Banks, mining companies, energy and autos. And they've all got their own particular issues. And you want to be selective within those sectors, but they're all sectors with very low, inexpensive valuations. And actually, in the world of slightly higher inflation, I think generally they will do better. And with respect to energy, well, I do not think we've been investing in energy for a long time. Investing in the transition, and we haven't even invested enough in renewable assets either. So a lot more investment in all of that. But while that's happening, prices for energy will tend to be higher, which is, of course, one of the reasons why we have inflation.
So just to jump in this, but on the banks, I know the argument obviously is rising interest rates, rising profit margins. Has the recent, kind of disaster kind of change that story at all in your mind, or is that more just it's contained to them?
Yeah, so I think it's a tricky one, because in the end it's quite binary. If this all becomes much worse for whatever reason, and becomes a more cascading problem, the stresses which sort of percolate out through the system, and you very, very quickly see problems, and effectively that's going to tighten lending, tighten the economy, tighten financial conditions. You'll see weaker growth, and really the banks won't do well under that environment. If, as we think, that the stresses somewhat cauterised, particularly in Europe, all the liquidity provided and the fact that the banks have very good capital positions, if that is the case and the damage to economic growth is really quite small, then you've still got to fight inflation, in which case I think that rate expectations are a bit low. Both short-term and medium-term, I think rates are going to stay higher for longer because we still have this inflationary problem, and that will be helpful for banks.
Now, we've only got a few minutes before we wrap up, but we've got a poll for you all to take part in a moment. If you can scan that QR code, that's how you take part in this one. It's just to get a view from the audience on what you think inflation is going to do over the next 5 years, and that'll pop up in a minute. But so, yes, Seema, what's your take on the equity side of things?
Exactly the same. I mean, value has to be one of the key factors. You know, after so many years of growth outperforming, last year was a real, I think, a real headache for portfolio managers of trying to accept that actually value could have a longer run than just a couple of months, which I think will become very accustomed to. But yeah, look, if you believe that inflation is going to be higher, then you have to start thinking about value. And, you know, like you're saying, there are going to be important value segments within every single sector. You know, I know everyone's going to hate this term, but this really is where active management is important, because you actually have to know where are the value, what are the specific of those sectors that could withstand some of the additional volatility that we're going to have over the next couple of years. So no, I think there's a wide variation, and I do think energy is a key place. You know, just harking back to your previous question about hyperinflation. Gosh, I mean, energy, commodities, any kind of the geopolitical order really changing. I mean, that is another scenario.
So my last question, and it's always the trickiest one, is 10 years from now, you have to lock up your money in one asset for 10 years. And you're not allowed to touch it during that time. So, and Seema, I'll start with you. Sorry. Whereabouts do you put it?
Okay, so I'm trying to weigh up I know you said I can't say equities. You want something more specific.
A little bit more specific.
A little bit more specific. Okay, so let me forget that then. Let me say anything private credit, private equity. I think, look, there's a very good case to be made that cyclically there's going to be problems in the next year or so. But if you're looking at over the longer term, I think that's where your greatest opportunities are.
Wow, that's really interesting. In fact, the next panel after this one's about private equity, so they'll all be pleased to hear that. Sharon?
Maybe I'll go a bit more broad. I mean, I do think equity, and then within that value equity, so maybe some income funds or value funds that have done poorly. A bit to your point that there's, you know, what has structurally not done well in the last few years, and if you think that things are structurally changing, maybe have a look at something which could structurally change and outperform for a period.
Am I allowed to say multi-asset absolute return fund, John?
Yeah.
I mean, I feel there might be a mild conflict of interest.
Yes, there might.
So, I'll be a little bit more specific.
Well, that would be the number one choice. But I think actually it comes back to the equity conversation. I would buy a basket of value stocks in all of those chains that I'm interested in. But I should say, we do think there's going to be a recession. If you look at the American market, it's priced for 0% earnings growth. It's on 18 times. You're going to get 15 off that in a typical recession at the end of the year. So opportunity is going to come to you. And that allows me to answer one of the questions that somebody put up about cash. Like, cash gives you a lot of option value, right? So it's counterintuitive. In an inflationary era, feels painful. But it's a lot less painful if the assets you want to buy fall 30% and you can then snap them up. So make the most of cash. You get paid now some kind of carry for the optionality, and a lot more bodies are going to come to the surface. Long and variable lags and monetary tightening, we are not through that yet.
So actually the answer is a better way. You won't want to sleep for 10 years. Yes, you want to have the money in the cash now, where you're getting a yield, and then use it.
Like trapdoor spider.
Yeah.
Well, I think that's almost all we've got time for. But can we just bring up the results of the poll, see what everyone thought? Now, oh, that's interesting. Okay, so basically, this is, I don't know if you guys agree with this, but I suspect you probably do, a low, so hardly any of you think it's going to be a low target in 5 years. A few optimists think it'll be around target. Most of you are opting for above the 2%, and a significant chunk think that the Bank of England will actually have to raise its target.
3% is the new 2%.
Yeah.
I think it'd be a long time before they raise the target. They may, they're not officially anyway.
I think it'd be too dangerous for them to raise the target in the next year or so.
Yeah, I think the Fed maybe has to do that first. It's hard to move out of line with the big central bank, isn't it?
To be fair, all the central banks had been moving before this most recent, before the pandemic and the recent sort of upshot in inflation. The central banks had started moving to average inflation targets, so they kind of crept that way anyway.
Yeah, I suppose they pulled back from the brink there, but
you can only do it though you can only explicitly do it once you have attained price stability. Otherwise, you completely lose credibility.
Yeah.
Well, that's it. Thanks very much. Thanks very much to Alex, thanks to Sharon, thanks to Seema, and thanks to all of you for all of your questions. Now, you're now due a coffee break, you lucky things, so you can get out and stretch your legs for about 20 minutes, but make sure you get back in the room, because actually we will be talking about private equity, private markets, which Seema brought up at the end there. And I, for one, I'm very curious actually to find out about that, because at the same time, it seems to be the kind of area where things could go wrong in the next year, but maybe not in a decade.
10 years.
Yes. So thanks very much. Thanks again to everyone.